Good morning, everybody. Welcome to See the Futures. My name is Jim Cagnino with NinjaTrader. It is May 24th, 2023. We have a fantastic guest lined up for you guys today. Before we go too far and before I introduce our guest, I do want to remind everybody, trading futures, options on futures involves substantial risk of loss, not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. Although that can be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, lengthen my retirement horizon, or overly stress me out. I make bad decisions as a human being when I'm under stress, so I want to be in a good spot. And remember, micro contracts could be friends. Easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. I do want to remind everybody, past performance not indicative of future results. All right. Well, thanks for joining us today. We have a half an hour and we got a lot of stuff to talk about. Joining us today live, Patrick Higgins from the Atlanta Federal Reserve Bank. Patrick is a policy advisor and economist here, joining us today live. Patrick, how are you?
Good. Thanks, Jim. Nice to see you. Glad to be here too.
Yeah, I appreciate you taking the time. I'm sure you guys are really busy. Love the work the bank does and all the great information. We're going through this period of the debate of soft landing, recession, no recession, hard landing. It's a continuous debate we're seeing all over the place. And one of the most important things that we talk about is GDP. What is GDP? So let's start with that. Let's start with the basics of what GDP is.
Yeah, so it's essentially what the value of all goods produced in the United States, essentially within the borders. And the way it's measured essentially is spending on final uses, essentially. So it's not measured when it's essentially produced. What people spend on things, essentially, that's how it's measured. And so there are equivalent ways to measure it, but the one that's kind of the most popular is GDP way. You could also measure it by income, and there's something called gross domestic income that theoretically should be identical, but there's statistical differences and things like that. But it's essentially how large the economy is, what's it producing essentially.
Yeah, so the typical GDP number, right? And it's, C plus I plus G plus the differential of import exports, right? That's kind of the textbook version I learned in college, consumption, investment. And G, what's the G stand for? Government expenditure or purchases, and then the difference in import exports. That seems to be a big challenge to calculate all that stuff.
Yeah, it's a very big challenge. I think when the BEA does it, they might have essentially like something like 1,000 subcomponents. So spending on things like milk, things like that ultimately goes into the ultimate number essentially. But once to aggregating the C plus I plus G plus net exports is essentially what kind of the bottom line users look at and things like that. But under the hood, there's definitely tons of data and pieces of information that go in to calculate it. Yeah, go ahead. Yeah. Sorry.
No, so the headline GDP numbers, that's issued by the Bureau of Labor Statistics, right? They do that. They try to analyze what happened last quarter, right? 30 days after the quarter ends for their first estimate, right?
Yeah, and then the other point I would say is there's sort of two types. There's the nominal, which is just pure dollar measures, and then there's real, essentially, so that adjusting for price changes. And so if you want to know kind of how quickly the economy is growing in some sense, people tend to look at the real, essentially. They don't want it. You want to see kind of adjust for inflation to see how the real thing is going to be more closely tied to production and jobs growth and things like that, essentially. So there's actually two kind of processes. You estimate the spending in dollar terms and then kind of the prices separately, and then combine the two to get the real GDP. And that sort of the top line number that's reported is going to be the growth rate of that real GDP.
Okay, and then there's a couple revisions, right? 30 days, there's a second revision. Another 30 days, there's a third revision. So at this point, we're almost a half a year into it, right? It's kind of delayed data.
Yeah, I mean, actually, the first estimate there, not all the data has come in technically. So the BEA, or the Bureau of Economic Analysis, that actually produces the number, they actually put in assumptions for things that haven't come in. And once those numbers come in, they release the second and third estimate. So in some sense, their first number is not a purely, there is some kind of judgmental components that are pretty small, but they are there that kind of get eliminated once they get all the data in. And then as more data comes in years later, essentially better surveys, those numbers change, essentially forever in some sense. But the first, and so I'm assuming.
Okay, yeah. So I'm assuming the assumptions become stronger and stronger as more data gets put into the pipeline.
Yes, yeah, the data gets better. Essentially, once you get these kind of year-end surveys where you have more people, more firms reporting their numbers, essentially, you get better and better numbers once you kind of get these annual surveys, years later. But the first three numbers are definitely the ones that people look at the most, and the first number is probably the one that gets probably the most scrutiny, I would guess.
I got it. Okay, that makes total sense. So now I want to pivot. So I want to pivot to what you guys are doing with GDP, which is creating a nowcast, right, through your GDPNow application.
Yeah, that's right. I mean, essentially, we can't exactly do what the Bureau of Economic Analysis does. We kind of do a kind of a rough approximation of what they do, and we release the numbers even with less data, and in some sense. So once, if not all of the data is in, we forecast what that data will be, and then produce this number essentially based on what those forecasts are. And as you kind of replace the data that's, if you're forecasting things like construction spending and things like that, once it's actually replaced with hard data, the forecast changes over time, essentially, as forecasts get replaced with data in some sense.
But the GDPNow cast, that the GDPNow is it tries to measure the current quarter, not the past quarter.
Yeah, that's right. It does at the very end of the quarter, maybe 3 or 4 weeks afterwards, it's forecasting the past. But essentially, once you're kind of a month in the quarter, you're forecasting what's happened already and what will happen essentially in that same quarter. And so it is kind of evolving from a forecast to kind of a nowcast based on data that's been released essentially. And so the day before the release, it's going to use almost all the same, the GDP release is going to have, 80 or 90% of the data in hand, essentially, that it could have in some sense.
Okay, and is there specific dates that you release updates?
Yeah, so there's kind of big data, I wouldn't say big data releases. Yeah, there's certain data releases that are released different times of the month. There's about half a dozen of them. So maybe retail sales is one of the big ones. That's in the middle of the month. Housing starts is shortly after that. There's things like the international trade is always early in the month, wholesale trade. And then the other big one besides retail trade is probably consumer spending numbers that are kind of released at the end of the month. That would be most of them. There's all other updates with kind of less important indicators that also get factored in the model, and so those are really kind of updated offline. And then once kind of the bigger data releases are released, then those kind of offline estimates are released to the public as well, essentially.
I got it. Well, let's take a peek at the latest snapshot. Let's put it on the screen. The latest snapshot, which I think was dated May 17th. For the GDP now, Mission Control, if you could shoot that up on the screen, that would be awesome. Again, so I'm just going to go through this because there's a lot of good stuff here. And remember, folks, you can get this on a mobile app, and we'll talk about that also in a little while. But I'm going to scroll down to what you kind of see on the mobile app, and you would see this chart, right? So there's a chart right here with some information on the left, and we start out with this blue line here that says blue chip consensus. What is that?
That's a survey of about 40 to 50, I would say, business economists, or essentially economy watchers. And so that blue line is essentially the average of those 40 to 50 forecasts. Essentially, there's 2 of those a month, essentially. And so that line is going to be essentially connecting those forecasts that are essentially twice a month, more or less.
Okay, I see. And so this is kind of like any kind of consensus when you'll get, you'll go online and see, okay, so it's, CPI was estimated at, core was estimated at 3.4. Some people would say that's, the consensus is, which is just a group of economists, right, that they chose to track and they average it.
Correct. Yeah, that's right. And the
So
shaded region. Yeah, sorry.
Yeah.
Sorry about that. Go ahead.
Well, no. So one more question on that. That's okay. Are these internal economists or are these external of the Fed system?
They're external. They're mostly going to be banks, but there are some like academic institutions. So essentially, probably half of them are kind of in the financial market, some associated with firms, but there's also just consultants and then even some academic, but no Fed forecasting there at all. I don't, yeah, positive.
Okay. Okay. And so go ahead. You were describing the range here. I'm sorry.
Yeah, that's essentially sort of the most optimistic, kind of average of the most optimistic forecast is kind of the top of the band, and the most pessimistic is kind of the bottom of the band. So if you're going to say most of the economists are going to be within that range, essentially, maybe not the very top or very bottom, but it's going to capture maybe 80 to 90% of the people that are making forecasts in that survey.
Got it. Okay. And now we're going to go to the green line, which stands out, right? This green line is the Atlanta Fed GDPNow estimate. Explain that a little bit.
Yeah, so it starts essentially when the previous quarter's number is first released. It essentially makes its first forecast for the next quarter. And so the beginning of that line is essentially 1 day after the release for the previous quarter. And that as it accumulates data, essentially, for each data release, the number changes in some sense. So you can see the line will be flat for a while. It either could be flat or just be 5 days since the last update, essentially. And kind of when there's a change, you'll see kind of a sharp spike up or down in either direction, essentially. And so we're just plotting those points.
Okay, so this goes all the way. This report was dated the 17th. This is what you're going to see on the app. But the shaded area, the consensus ends on the right before the 5th, I don't know, 5th or 6th or something like that. So this is a continued forecast from your methodology.
Correct. Yeah, it'll the actual survey might be 5 or so days before it's actually released to I think this is proprietary essentially, but there's other surveys like this. There's a Wall Street Journal forecasting survey, so it's always going to be maybe 5 to 7 days. When they actually submitted the number, it'll be another week or 5 days or so before you actually get to see it in some sense. And it could be the last forecast could be 3 weeks ago or something like that. So it can be more than a month old in some cases.
I see. Okay. All right. Well, this is it just seems like Atlanta Fed GDPNow is more optimistic than these grumpy economists down here, suggesting a rougher time.
Yeah, I would say the past few quarters have been kind of like that. So kind of the professional forecast actually kind of expected close, probably 0 to 1% growth or something like that. And then as data kind of came in, it revised up essentially. So it's kind of been a similar story. Kind of they're seeing a softening of the economy in some sense that is anticipated in some sense. So the model is not necessarily anticipating what they're anticipating, but as kind of more data has come in, they've gotten closer essentially in time, which tends to be the case, not always the case, but they tend to get more similar to each other as more data comes in essentially.
I see. Well, I'm going to scroll down a little bit and we can get into some details here because I thought this was interesting as well. Am I in the right? Yeah. Okay. So I'm just going down here. In mission control, if you can cut and paste that PDF into the chat, that would be awesome. So Atlanta Fed GDPNow estimates, and then there's a spreadsheet here with a bunch of different columns. Could you walk us through this?
Yeah. So the first 2 columns are essentially when the forecast was updated, so these are a combination of the dates that actually GDPNow was released, but some of them were internal updates that were released later in some sense. And the releases themselves, the GDPNow is using, and is that second column. And the third column is essentially the growth rate for real GDP for the quarter, is essentially kind of the top number that you would see in the Economy Now app that's the number that's going to be advertised essentially is in that column. And the columns to the right.
Wait,
Yeah,
so just, I'm sorry, let me catch up here. So the GDP column here, that's the one you're just referring to.
Correct. Yeah, the one in blue is the GDP, sort of the top line number.
Okay, and then going to the right.
Yeah, so when the BEA releases their numbers, they do have these contributions to growth. So essentially, why did the number go up or down, or were there offsetting factors essentially? And so GDPNow is essentially reproducing that calculation more or less. And so within each row, essentially, to get that the column in blue, just add the numbers in the same row to the right, and they will add up to the number at the in the left column essentially. So you can see for after the housing starts, if you want to know how the 2.9% number is arrived at, the PCE column, which is consumer spending, that's probably the most important column, I would say, after GDP, since consumer spending is something like 70% of the GDP in kind of nominal terms. So that'll often be kind of the biggest contributor, but other things to the right of that, there can be negative contributions that kind of offset that. I would say the three columns to the right are probably the noisiest components, and they might not, they can have a negative sign when every other sign is positive, things like that, essentially. But those numbers are going to add up in some sense to the GDP column.
So are they weighted or not, or is it just simple addition?
Yeah, so the spreadsheet before, the way that actually, if you want to do kind of a rough calculation of what the contribution is, you just take the growth rate of the subcomponent. So the PCE, which is consumer spending, take the growth rate of that, and then multiply it by 2/3 or 0.7. So if you went to the spreadsheet before that, consumer spending growth rate is probably going to be something like 1.6 or 7%. Yeah, 1.6%. So just take 70% times that number, and you'll get the contribution to growth essentially. In this spreadsheet, these are actually just the growth rate. So it's calculated the same way as GDP, but just looking at a specific investment component or government spending or exports or consumer spending, things like that. But since they're only a partial share of GDP, the numbers in this table are going to be probably bigger, either positive or negative. They're going to be further away from zero than the numbers in the sheet you were showing before, essentially.
I gotcha. All right, I'm going to go back down to that. Is this intellectual property production? Is that, I haven't seen that before.
Yeah, so that a lot of that's going to be software in some sense, but there are also things like artistic originals, things like that, research and development, things like that. Those are actually probably the data for that comes in the latest, essentially. So that's almost no data in some sense is kind of informing those numbers. And if you look at the column, essentially it's not moving very much at all. So it really doesn't change a whole lot. And the kind of the most reliable data is not released even in the first GDP release. That number is probably the most subject to change. The good thing is it tends to not be very volatile. So you can kind of put in a rough guess, and it's probably, even if you get that somewhat wrong, it's kind of not going to ruin the rest of the forecast.
I can't even imagine how someone would try to calculate that.
Yeah, it is. It is. I would say there's a lot of sort of the best measured part of the economy. It's not probably as well measured as some others, and it does take kind of more care and kind of better surveys to get it. But yeah, obviously measuring research and development and things like that, going on software, is going to be less difficult than looking at kind of the retail sales report to get the consumer spending number.
Okay, that makes sense. And the far right column, CIPI, what is that?
Change in private inventories, essentially. So if firms are essentially drawing down their inventories, this is actually the actual subcomponent itself is going to be either a positive or negative number. So if firms are essentially adding to their inventories, the change in private inventories is going to be a positive dollar number. It could be a negative number if they're drawing down their inventories. This contribution is essentially saying are they drawing down their inventories or adding to their inventories more than they did the previous quarter, essentially? So if they added their inventories last quarter and they add at the same rate this quarter, essentially, then this number is going to be 0, essentially.
I see. Okay. Okay. All right. Very interesting. Yeah. I mean, very, very interesting. So we're kind of under the hood now and how this is all calculated, which is super cool. Here at the bottom, we have maximum forecast of real GDP growth. This is, I think, kind of what you'd call the headline number here at 2.9%, which I think is what you'll see on the web app.
Mm-hmm. That's right. Yeah.
Okay. And then underneath it, minimum. All right. So this is from April. This is the minimum forecast of real GDP growth, 1.7. So there's clearly been a change. It's kind of bumped up, right? So it's suggesting the trend is positive.
Yeah, and sometimes it's saying kind of the data has come in, roughly speaking, has kind of been better than the model expected. That's usually how, it's not always how it works out, but that's probably the best kind of rough way of explaining it.
Okay, I see. And so we have a May 17th release. When's the next time this will be updated?
So that'll be Friday. I think so that's 20, is it 25th? Is that right? It'll be Friday. Yeah.
Right.
So essentially kind of the full consumer spending numbers will be released that date. The retail sales is kind of the goods part of it. And so that the consumer spending will include that spending on goods and then also on services, essentially. And so that the number tends to change a lot on those days. Retail sales, retail trade, and kind of consumer spending are kind of ones where it could move up or down depending on if the model is surprised kind of by the data release or not.
I see. Okay. So it is subject to not real time, but close to real time other data that just pops in there.
Correct. Maybe so the May 3rd one, you can see kind of the number went up a lot that day from like 1.9 to 2.7. And that's essentially because the auto sales numbers, those actually are released even before kind of retail sales numbers. They're kind of the first data point anybody gets. They can kind of turn those around the most quickly. And so that number was surprised the model. It came in stronger essentially than the model expected. And so you can see the consumer spending number went up a lot on that day. The GDP went up essentially, which is most of the movement.
Yeah, that's a big jump up from May 2nd to May 3rd, and then stays constant, pretty much close to where we're at right now. And really, the most fascinating thing about this to me is you could really see the evolution of the GDPNow estimate, because it's based on data that's published right here, and it's you don't know what it's you don't know what the employment situation is going to be ahead of time.
Correct. Yeah. So I would say the employment situation is more, it impacts more how the model forecasts the rest of the data is going to come in. That data is actually not kind of an integral part of how GDP is estimated, but it is, how strong the economy is in some sense. So the model is using that in more a sense to forecast what's going to happen for the rest of the quarter. So if it got a big negative jobs number or a big positive jobs number, the number could actually change, and sometimes even though it's not tied to a particular subcomponent like auto sales is.
Right. That I get it. That makes total sense. All right, great. I mean, this is pretty much a moving consolidation of information. Is our traders get them right, and then turning that information into a new GDP estimate.
Yeah, I would say this is not a perfect science. I guess one thing would emphasize, so you can see in that chart, the GDPNow disagreed with the blue chip economists. Even by the end of the quarter, there's not going to be kind of perfect information. So I wouldn't say this is kind of an approximation for kind of what the street view of what the GDP release is, or even maybe the best forecast. Some quarters it does well, but other quarters it doesn't. It's just kind of one data point, and kind of where it adds value in some senses, it is kind of able to kind of capture these releases in real time. And even if it's not, you would want to look at how other people are doing this, but it is kind of one thing that you can see kind of right after the data release to see how that affects the GDP number, at least from this model's perspective.
Got it. So on the app itself, on the web app itself, this is a web app, folks. You could download the web app on your. I have it on my phone. There's more categories than just the GDP Now. The web app is called Economy Now, right? And you could find that in the store or on the website. And it has other categories. It has the market probability rate of a rate hike. And I did go through that calculation a little bit earlier today. It's a different approach than some of the other, like the Fed funds tool that the CME does, but it's giving some pretty good information. We have sales revenue growth uncertainty, wage growth tracker, last labor report, sticky price CPI, and business inflation expectations. So there's a lot of data here in addition to GDP Now that you get from that web app.
Yeah, I would say kind of the most popular Atlanta Fed releases are probably on the app. So if you kind of want to see what most people are most interested in and kind of the top number on your iPhone or mobile device, that's probably the best way to do it. And if you want more detail, you can go to the website itself and you kind of dig into the every data series that's released related to these things. But kind of if you want to quick view of what's happening, that's probably the best way to get it.
Got it. All right, very awesome. I was so excited to start. I forgot to ask, Patrick, where are you from originally? You're in Atlanta now, right? Where did you come from?
Yeah, I'm actually from Ohio, so I was lived in Columbus mostly until I went to college, and went to Oberlin College, and so an economist at the Cleveland Fed actually taught there for a semester, and so I actually went to the Cleveland Fed fairly shortly after college, essentially, and then eventually moved to Atlanta maybe eight years or so after that, and had been there since 2007, essentially.
Okay, so you've been with the Atlanta Fed since 2007.
Correct.
Okay, that's awesome. Yeah, I love Atlanta. I'm from Chicago. I moved to Charleston, and made the move down here, and love it down here. And how do you like Atlanta?
Yeah, the weather is definitely a big plus. I don't miss Ohio winters so yeah, and it can be a little cold. It's not, but I mean, cold here is definitely not cold in Northeast Ohio, so it's definitely a plus,
right.
And I like it a lot, definitely.
So you're in the office now, obviously. Is there some remote work going on, or is it all you guys got to be in the office?
I would say it's hybrid. Yeah, so there's definitely we're in an office some, but there is still kind of teleworking, or so it's kind of a mixture. I think most banks are like that. There's slight differences across banks, but I think that's mostly how it's working. But there is definitely an in presence in the bank several days a week, essentially.
Okay, I got it. And if you don't know the exact answer, that's okay. But how many employees? How big is the bank?
It's roughly 1,000. I might be off a couple hundred in either directions. And there is some branches. We have branches in Jacksonville and New Orleans. So I'm not sure how those are much smaller than the Atlanta, but they have less than 100 employees, but definitely more than 10. So they're, within the sort of 6 districts, it's probably more than 1,000, less than 2,000, I would think.
Okay, so a decent size, but not huge, not
Correct.
Many thousands. Wow, very interesting. Yeah, I'm from Chicago, so the Chicago Fed building is right across from the Chicago Board of Trade, where I've spent a lot of time in that building. It's a security guard. They have a museum in there. It's pretty cool, and you can get in there. But beautiful building, and you see people coming in and out, but not a whole bunch of them. So interesting.
Yeah, we have a museum here as well. And it definitely is open to the public. Something like 9 to 10 to 3. So if you're interested in that, I would recommend it, certainly.
I'm going to make the drive. It's 4 hours. I can get there pretty quick from where I'm at.
Good.
Anyway, so our half hour's up. Patrick, I really appreciate you walking us through the details here on the app. I love it. Appreciate you taking the time out of your busy schedule to be here with us today.
Yeah, thank you. I enjoyed this, definitely. Thanks.
Very awesome. All right, folks, thanks for being here with us on See the Futures. And I do want to remind everybody, most important message of the day, please be safe out there, be good to each other. Thanks for coming.